Today is day two of the Silicon Valley Bank crisis. And I think what is coming out is the lack of liquidity that Silicon Valley Bank had and the lack of regulation among financial institutions in terms of forcing mark-to-market accounting on short-term investments. Typically, there are no losses on short-term securities if they're held to maturity. I suppose that's true with long-term, although there's a longer-term horizon. But short-term securities relative to holding to maturity will have no losses. But the problem for banks is the need for liquidity. And if a bank has a run on its liquid capital, that can cause problems and force banks to liquidate securities that they might not always want to. One could argue in the case of Silicon Valley Bank that this was a little bit of a self-fulfilling prophecy when the venture capital firms decided to pull huge amounts of capital out of the bank. They essentially lost a good resource to provide the preferential banking needs that they often require. I was a lead investigator on a Canadian failed life insurance company. They had 80% of their investments in mortgages when most had 50%. They ran into liquidity problems and couldn't sell off their mortgage portfolio without taking big losses. Their ability to satisfy guarantee annuity contracts and life insurance settlements was impaired by the illiquidity of their investments. Regulators tried to get other life insurance companies in Canada to buy the failed entity in hopes that such a consolidation would not impair the faith and credibility in life insurance companies. But the reality of it was that at the time of the failure and the freeze on assets, there was billions of dollars estimated in losses. And however, after 3 years, the market did stabilize and almost no loss was incurred. But at the time of the consolidation or the potential acquisition of this failed company, the life insurance companies that were interested could not figure out where the hole was. And those could all be instances that Silicon Valley Bank suitors might be facing as they go to the market for the second time to try to sell the bank. The lesson learned, I think, is patience. Again, 3 years, there were no losses. And the question, I think, if the government goes to mark-to-market accounting on short-term securities, how much Tier 1 capital will also be eroded. If the regulators tighten Tier 1 capital requirements, that will impair the bank's ability to hold marginal credits. And marginal credits are often found in middle market and closely held companies who often don't have the financial resources of larger companies. And I believe that this could have a very detrimental impact on the availability of credit for middle market companies. So stay tuned. I think there's more to come on this, and stay liquid because in the short term, this needs to get sorted out before there's more catastrophe in the financial markets.